Good afternoon.
As mentioned in the US, a mixed picture on the jobs front for August, providing little clarity on an anticipated Fed move. The US economy added fewer than expected jobs during the month, but the unemployment rate did fall to a 7-year low. Let's get some more analysis for you on these numbers. Live to Michael Wayne from KOSEC, joining us in our Sydney CBD studio. Michael, before we get into US jobs, I wanted to ask you about our top story first and foremost. China has cut its 2014 economic growth to 7.3% from 7.4%. Do you see this as, I guess, a public admission that growth is slowing? And can I get your reaction to that news?
Yeah, look, I mean, it's obviously a public admission. It's not that unsurprising. They've definitely been slowing. They've been slowing for a very long time. And they have come out, they've already cut their currency peg. That's also an indication that they think their economy is slowing, so they're looking to prop up their exports there. But as I've alluded to in the past, they still have a lot of ammo up their sleeve. Their interest rates are very high. Their reserve requirement ratio is still very high. And they've also got the capacity to roll out further stimulus projects if need be. In the end of the day, there's not much difference between 7.4% or 7.3%. I haven't actually come across that. I was just sitting in the studio waiting to come on air, so it's the first I've heard of it. But yeah, it is interesting to see, but it's not all that unsurprising.
Let's move our focus over to the United States. Of course, we did see markets sold off on those positive job numbers. Jobs growth falling short of expectations, coming in at 173,000. But what's interesting as well is that prior month's data has been revised higher. How did you read it? What did you think when you first saw it over the weekend?
Yeah, look, net, nothing really changes, I think, in the eyes of the Fed. But if we look sort of below the headline unemployment figures, the Fed will be concerned over a number of different measures that they'll certainly be looking at. The participation rate, for instance, is currently below 63%. Prior to the GFC, it was up above 66%. If you look at the long-term unemployed, for example, before the GFC, it was about 19%. It's currently sitting about the 27% mark. You can look at things like the underemployment as well. That was about 9% before the GFC. It's now about 10.5%. So you can see why it's not a clear-cut decision for the Fed. A lot smarter men than I, such as Bill Gross, Mohammed El-Haran, they've all come out and said they probably had a window of opportunity there to raise rates. They've just had to sort of adjust things to take into account the volatility we're seeing in emerging markets at the moment. But I do think the underlying economy can definitely have supported 1 or 2 interest rates by now, but it's more of a psychological impact. And if we look at, say, bank lending standards, they're still pretty strict over in the US. Corporations aren't really adjusting their hurdle rates. So I think those things have a more larger impact on the real economy than the interest rate itself, but the interest rates obviously has a sentiment side of things. Yeah, it's attached to the sentiment, really.
Has the Fed missed an opportunity?
Well, that's the train of thought. We did go through a period where things were quite benign on the global front. At the moment, there's definitely elevated concerns about the emerging markets. Their currencies have obviously been depegged versus the US dollar. So a lot of their debt's denominated in US dollars. If the interest rates was to increase on top of that, their repayments all of a sudden become a lot more expensive. So there's a number of different jitters that causes. So I think for now they'll just probably shelve September. The bond market's pricing in 20% chance in September, and that's probably right. Whether it's December or early next year, I don't really think it has a fundamental impact on the global economy, but it's definitely the sentiment that it creates and the market jitters that it creates that the Fed will be concerned about at the moment.
Do you subscribe to the theory that the Fed might be better off just getting it done as soon as possible and then putting to rest a lot of these, I guess, concerns that often get thrown up if September would pass without a hike in rates?
Yeah, look, I think they're going to have to raise interest rates sooner or later. I think the market knows they're going to raise interest rates. It's just a matter of time. Whether that's a 0.25% interest rate rise or whether it's something slightly less, I think it would make sense just to get the ball rolling. But whether to do it at the moment when markets are very jittery, we're seeing volatility again today in the ASX, I think now is probably not the best time. So I think they might even see December will be probably the more likely outcome now.
In your view, what's the ultimate risk for the Fed in not achieving that public ambition of raising rates towards year end? What do you see as the ultimate risk? Is it China?
The ultimate risk, I think, is more so just the stock markets or global financial markets and sentiment. I don't think it really has a big impact on economic growth, and I think the markets will work that out over time. A lot of the research that we've done suggests it's not really until the 3rd or 4th interest rate rise in the cycle that really starts to bite into equity markets, and this time we're coming off a very, very low base. So I don't expect there to be too much impact on the real economy. There might be a little bit of a market shakedown for, say, a couple of days or a week or so, but then there's also a good chance it could be sort of sell the rumour by the fact. The market knows it's coming. When it eventually does happen, they might just throw their hands up in the air and say, look, everything's okay, everything's going on as normal, the global economy hasn't fallen off the cliff or anything like that. So I think, yeah, that's probably the case. The biggest thing is probably the risk to the markets, but it could only be a day or a week situation where the markets go through a volatile experience. But long term, I think it'll be okay. They'll realise everything's okay.
All right, Michael, let's get your reaction on, I guess, what else is moving at home as well. We saw the Australian dollar hit a 6-year low. Currency trade hitting equities as well?
Yeah, look, I think there could be a case where people are getting out of the carry trade, particularly the overseas investors. They're not only getting hit on the equity side of things, but they're getting hit on the currency. But there are good reasons why the currency has come back. If we look at the 10-year Australian government bond compared to the 10-year US government bond, 1 year ago, the spread was about 1%. At the moment, it's about 0.5%. So that spread is narrowing. That's obviously putting down pressure on the dollar. Obviously, we had some weak GDP figures last week, some weak retail figures. So the chance of an interest rate cut in Australia has probably increased somewhat. And obviously, the terms of trade continue to deteriorate. The Australian currency, I think it's the 5th most traded currency in the world. It is only AAA rated currency in the top 5. So that was providing a bit of support for a while. But as the terms of trade and commodity prices continue to come down, the government tax receipts start to come or get called into question. So the gloss of that AAA rating probably loses a bit of its lustre. And that's why we're seeing the continued pressure on the Aussie dollar, I think.
Can we get your thoughts on what's happening with the market today as well? Of course, we did dip below that 5,000 point mark. At the moment, we're up 5,015, down just 0.5%. So it seems as if the local market is paring back some of the earlier losses. But what are you focusing on in the session? I guess all of the big 4 banks are on watch as always.
Yeah, look, I mean, we're focusing on every stock really, particularly the companies that benefit from the falling Australian dollar. But the banks, obviously, we've been looking at them as well, but we're a bit cautious on the banks at the moment. Obviously, their profit growth has been helped along by the low level of bad debts, but whether or not that's been exhausted, I think it probably has. The banks have also been required to raise capital, so that puts downward pressure on things like return on equity if they're forced to raise equity. And if we look at something like a Commonwealth Bank, on one hand, they're going to their shareholders and asking for $5 billion in capital raising, but on the other hand, they're paying out $7 billion in dividends. So the net impact is zero, and it's probably detrimental to shareholders' returns. So in our opinion, although the banks are definitely looking cheap on a yield basis, the fact is if their earnings growth, if their return on equity and their margins are under pressure, we see it might be very difficult for them to increase dividends at the rate the markets become used to. So Westpac's presentation, it's great. These things always sound great in theory, but time will tell in terms of execution and with the broader market or the broader banking sector as well.
What do you think about that 15% ROE target from Westpac?
Yeah, well, look, it's above that at the moment, but as I said, this return on equity is going to continue to come under pressure considering they have to raise their capital. So if the banks are going to their shareholders asking for more capital, asking for more equity, they're forced to hold more equity, and they're being forced by APRA to hold more equity. One thing with Westpac is they might benefit, or they're one of the companies or one of the banks, along with the Commonwealth Bank, that will benefit from their repricing because they have such a large mortgage book. But at the moment, look, that 15% return on equity is a good target to have, but there's no doubt that if they're forced to hold more capital, it puts downward pressure on their return on equity and all their margins and their profitability for that matter as well.
All right, Michael, we'll leave it there. Thank you for joining us today. Always appreciate it.
No, appreciate your time. Thanks for having me.